Welcome everybody. It's Friday as always. Looking forward to our live stream and for all of you who are here. I'm grateful to have you here and looking forward to what we have to talk about today. Really quickly, uh, just a couple of simple things. Uh, I'd like to try to encourage as much participation in these live streams as possible. Please feel free to make use of the chat area. I'll be paying attention to that throughout the course of the live stream. If you have questions, comments, feel free to offer those up. This is a live stream that I'm making available to the entire public, and not only for paid subscribers, but anybody who has signed up uh, for a free account on Substack. Um, so, with that in mind, I want to give a little bit of an introduction to Rebel Income and what we do before we start diving in to what's been happening this week. Start evaluating some of the trades that I've been following for the last few weeks. Rebel Income is really all about options-based income generation. I like to talk about uh, picking the low-hanging fruit of the stock market. And to me, what that means is that there are opportunities through options by being a seller of options, taking the sell side rather than the buy side. There are opportunities to pick up money that the rest of most of the market is just simply ignoring. That's why the focus of the trades that I write about and that I publish for my paid subscribers are focused on put sales, covered calls, and if you want to go a little bit with a little bit more conservative variation, then you'll see that I also publish bull put spreads as well in those trading alerts. Why use put selling as a centerpiece? Why not buy a stock outright? If the point here is that I think that a stock is a good value, it's fundamentally driven, it's trading at a significant discount, offers a nice dividend. Why not go ahead and just buy it outright? Welcome, Gib. Excited for everybody who's here. Why not go ahead and buy it outright? I'm going to go ahead and I'm going to use the stock that is on deck to the trade that's on deck to expire today, and that is a put sale on Skyworks. Now, when I placed this trade, this was a month ago. This is a 30-day trade, and instead of just buying the stock at its whatever the price was at the time, it was a little bit above 67.50. I sold the 67.50 put. Why did I do that? Well, I didn't know whether or not the stock was actually going to start going up in the short term, and I'm not really interested in trying to predict that. One of the things that I have learned over my decades in the market and as an investor is that trying to guess the direction of what the direction of any stock is not a 50-50 proposition. It's much less. Probabilities of success when you, excuse me, I apologize. I'm feeling a little bit under the weather, so if I sound a little bit congested, I apologize. I'm trying to fight that a little bit. One of the things that I've learned is that if I want to be bullish, buying a call or buying a stock outright, or if I want to be bearish, buying a put or shorting a stock, these are what I call directional strategies. They have a very low probability of success. Instead of being a 50-50 coin flip, we're really talking about maybe 25 to 30% probability under the best circumstances. Now, it is possible to make money even with those low probabilities if you have the ability to make sure that your winning trades have enough profit to offset all of the losing ones, then you can still make money. But that's a process that requires a high level of discipline as well as skill and, in all honesty, a little bit of luck. The truth is, that I don't believe that the majority of retail investors have the ability to be successful with those kinds of strategies. I know, speaking for myself, I represent that majority that I just talked about. I tried working with those strategies for years and years and years. And I did okay sometimes, but I certainly lost a lot more than I made. And in the long run, I ended up just being frustrated. One of the turning points for me came when I started to realize that I didn't have to work only the buying side of an options trade. If I'm looking at a stock like Skyworks, let me pull up their chart here. If I'm looking at a stock like Skyworks that I like, there is an opportunity just to buy it outright. And speaking strictly in terms of retrospect, in hindsight, if the stock was at 67.50 a month ago and I bought it, and now it's around 73, that's an opportunity to have made $5.50 per share, which is a pretty nice return in 1 month time on a stock that was down in the high 60s. Not knowing whether or not that was going to happen, though, this is where the stock was at when I placed the trade. It was down in this neighborhood. It looked like it was starting to kind of consolidate between support and resistance. And these consolidation periods, sometimes they only last a little while, sometimes they can last a very long time. It broke out temporarily, got up here to close to $80, and it's been tracing back since then, but it's still well above the 67.50 price that I was able to sell, which is down around here. So why not buy the stock outright? Well, the simple truth is that what was available was an opportunity to sell a put option at 67.50 and to bring in some immediate income with that trade, $1.35, just 2% on the capital that I committed to the trade. I sold one contract, so that's $6,750. And so I brought in $135 in premiums. I like that. The stock was above that price, and so by selling the put option, I was able to secure myself an acquisition price, for lack of a better word, a buying price of Skyworks below the stock's current price, at a price if I liked it at whatever the stock was at, 68 or whatever at the time, 67.50 is a little bit better. And that's one of the first things that selling a put option does. So it allows you to set the price that you're willing to buy the stock at. Some people will talk about the risk associated with selling a put option, because the truth is, if the stock drops below the strike price you've sold, you're going to be assigned if it's below that price at expiration. Clearly, Skyworks in this case is above that price, so I'm not looking at an expiration right now. But if it were below 67.50, I'd be looking at that likelihood. The risk is, what if it's at 63? What if it's at 60, or even lower than that? That does happen, and that's something that you have to decide. And that's why one of the reasons that I call put selling a gateway to stock ownership is you need to go in with the understanding that put selling trades do mean sometimes put assignments, and you have to decide whether or not you're okay with that. The way that I use put selling is to set the trade and then let the result be the result. If I'm assigned, I take that assignment. I like these. These are stocks that I want to own anyway, and so if I feel like 67.50 is a good price, I'm going to accept that price, even if the stock is below it when I'm assigned. That's going to set up an opportunity for me to wait for the stock to recover. I always only work with dividend-paying stocks, and so I also have the opportunity to earn the dividends that come in from those stocks. So this is combining some short-term trading methods with put selling and covered calls, with a long-term perspective that is common to value investing, to fundamentally driven investing as well. That's why I put such a focus on fundamental strength in my analysis. Why I'm specifically looking for not just dividend paying stocks, but dividend paying stocks trading at steep discounts with a strong base of business beneath them. That doesn't mean that the stocks won't continue to drop in price potentially, but it does tend to increase the likelihood that the market is going to recognize that discount sooner than later. And so that's usually what I'm going for. And that's what's been happening so far in Skyworks. Now, unless we see a real major collapse here, I don't think that I'm going to be assigned. So that's going to be, this is going to go down as for a lot of people in our community, in the Rebel Income community that are working with the same kind of trades, are going to call this an ideal result. This is just a good result for me. I don't mind not being assigned either. It does open the opportunity for me to recalibrate once the option has expired, and next week when I'm ready to publish the next trade, to evaluate whether or not I want to use Skyworks again for that trade. We'll see. It is coming up on earnings, and as much as I can, I prefer not to try to cross an earnings report on an open put sale. I'm not afraid of it necessarily, but I know that for a lot of the people in our group, that is something that you're kind of nervous about. So I try to minimize that risk as much as I can. But it's going to be interesting to see how that shakes out. So for now, Skyworks looks kind of interesting. If any of you are also working with the same trade here on Skyworks, feel free to compare your numbers for me, and love to see how everybody else is doing. That's kind of an overview of the reason that I use put selling as the primary type of trade that I'm using when I publish my trading highlights on Substack. If you're if you're on here and you're paying attention to this after the fact, if you're a free subscriber on my Substack, you're not a paying member. You're not getting access to those trading highlights. This is something that what you are seeing when you see me publish a report is the type of analysis that I'm doing, that I'm subjecting, not only for purposes of those reports, but this is the core analysis that I'm applying for every single trade that I take with Rebel Income, and that I've been doing for over a decade. This is the way that ultimately, speaking for as a personal investor myself, this is the way that I prefer to invest. And I've been able to shift those probabilities where I said earlier, the normal probability of success is 25, maybe 30%. I've been able to actually reverse those to above 98% winning trades. And I don't say that to brag, it's just a fact. It's I have 10 years of trading history behind me. You can look at the track record on my Substack and see for yourself. Okay. Well, that's Skyworks. Again, feel free to compare. I'd love to see what everybody else has going on that one as well. Now, one of the things that a trade like this does, of course, is it opens up the opportunity to evaluate what you might be able to do now. If, excuse me, I brought in $1.35 when I placed this trade. And the truth is, if you've been watching the stock, you probably got out of the trade. If you're not necessarily looking to take a more passive approach like I do, where I let the result be the result, as they say, you may be looking to be a little bit more active. One of the things that you can do at this stage is to think about buying the option back. You're selling to open, and so you buy to close. What that does is that eliminates the possible obligation before the market closes. There's an advantage to doing that versus somebody like me who simply lets it expire and then I move on. And the advantage to that is that you're able to increase the compounding effect on your account. By allowing my trade to expire today, that means that the capital, the $67.50 I put in to secure this contract at $67.50, that capital isn't actually going to be available again until Monday or Tuesday. That's not a problem for me. I'm okay with that. I can work with that. I've been working with it for a long time. But if you had an idea of something else you wanted to do with the money, buying it back right now would give you the opportunity to redeploy that capital sooner. Instead of waiting for the normal trade settlement, buying it back means that $67.50 becomes available for the next trade as soon as this one clears. Now, just to kind of put this in context, we can see that there's been no volume so far early in the session here at this $67.50 strike price, which is why the ask is sitting at 75. In fact, there hasn't been any movement on this contract for the last 4 days. Still, if you were to, there is enough open interest here and we are seeing enough extrinsic value, which is really just whatever is left in time for today's trading session. There is enough of that left that you could probably, if you wanted to, if I wanted to close this out before the market closed today, I could put in a buy to close at 5 cents. I might have to wait for a little bit to see that come through, but I would probably be able to buy that option back before the market closed today at 5 cents. And then that capital will be available again for me to redeploy. Do I want to redeploy it with the same stock? Maybe. Again, remember here, these guys are due for their next earnings report at the end of July. So that means that without weekly options here, you'd be having to have to decide whether or not you're willing to hold a put sale through an earnings announcement. That's also one of the reasons that the premiums on these are pretty elevated right now. Here's $1.55 at $67.50 for next month. That's interesting. $1.55 at $67.50. A little over 2.29%. That's above the yield that I gave myself with the current trade that I have. But be clear, before you're tempted by that kind of yield, this is due to a higher level of implied volatility in these options because of the earnings report. This is these options expire August 15th, 2 weeks after the earnings report. That doesn't mean you have to hold them that long, of course, but that is the reason that implied volatility is higher. That there's a higher level of unpredictability that you can expect to see in the stock for the next couple of weeks leading into the earnings report. And so if you're willing to kind of surf that wave, I guess, then maybe that's something to think about. Speaking for myself, I'm okay with letting this one settle a little bit, and we'll probably put it aside till after the beginning of August. Okay. That is, again, as I mentioned, that's really the only trade that I have that is on deck for expiration today. Gib, do you look at the star rank? I really don't. Rankings don't really mean a whole lot to me. I'll be honest with you. Are you talking about these rankings over here on the right from Morningstar, CFRA? I like to read the reports from CFRA. I think that they are actually generally pretty good. I don't always agree with all of the analysis that they give, but a lot of the information that is in these reports is very useful. They are, if you're looking at the ranking here, obviously they're ranking this as a sell rather than a buy. That's primarily because these reports are growth driven, not value. But they can be useful for just gathering additional insights. There is sometimes really good detail about what's going on in the business in the CFRA reports. Morningstar a little bit as well. Most of the rest of them, when you talk about like the Schwab equity rankings, Argus, Market Edge, the rest of these tend to be mostly quantitative, based on price movement and those kinds of things. So you don't get the same level of depth in the overall analysis with those reports. So the star ranking itself, I don't really pay a whole lot of attention to it. I will read reread the reports from these guys. Hope that helps. Barry, nice. 2 on deck today from the Rebel Income group of trades. MGA call for 42.50 and SLB for 36, plus a 45 call for Polaris, which you've talked about on a few occasions, Barry. Thank you. No problem, Gib. I appreciate the question. So let's take a look here. I appreciate this. We do have some other stocks we'll talk about, but we can wait. So Barry has bought MGA, sold a call for 42.50. It's a little bit below that, and it looks like we've got the stock really, the top end of its range for the last couple of weeks is about 42.50. So you need to see a breakout there and a resumption, an extension, I should say, of the current upward trend in order to be called out of that trade. Doesn't look like it's going to happen. But that's okay. I'm assuming that you don't mind holding on to the stock for a little bit longer. It is developing a nice trend. We do have, again, the earnings report coming up. Earnings reports aren't categorically negative. Obviously, the market often will push the stock higher after an earnings report, depending on how the market perceives the information that the company announces, right? The only reason I point out that earnings reports are coming up is because you can expect the price to be more volatile. That doesn't automatically mean bearish. It doesn't automatically mean bullish. It just means volatile. So Carl, the fundamental analysis sheet used back in the investive days, better way to determine a stock company's health. So Carl, I'm going to go ahead and assume that you're talking about the same sheet that I've shared a few times. It's still what I use. Barry is willing to hold on to MGA because if it stays where it is, maybe I'll write a higher call next week. You're exactly right. MGA is a stock I have used for a number of trades. I don't have any open ones, but it's a stock I like. So yeah, this is Carl. This is still the same analysis that I'm building the case for all of my trades on. So, you know, I'm assuming, Carl, you're referring to Gibbs' question about the star ratings and rankings. Again, I will read those reports just because, you know, every little bit of an extra analysis I can get can be useful. It's a good way to find insights that I may not have been able to dig up myself. And so in that context, it's useful. But yes, this is what we have here in terms of the overall analysis that I rely on for the trades. It's this. These are the details that I'm paying attention to. These are what I'm analyzing, and what I'm using as the basis for what my decision will be. So, thank you, Carl. I appreciate that. A little plug. All right. Barry, entry on MGA 4250, writing higher calls than you were. You got out, but I'm still in it from September. Got it. Got it. So you're just a little below, but I mean, net result, right? Based on all of the calls you've been able to do, you're in it on a net basis, and net cost basis. Barry's doing pretty well. So still holding on to that stock, which is a good thing. All right. And then SLB, you said, was 36. And this one is breaking down a little bit. We're seeing an increase in bearish momentum here. Over the last few days. Yeah, just use the stars as a filter. Yeah, and that's fair. If you find it useful that way, if it helps you to, if it's one more way to help you filter things down, that's nothing wrong with that. Again, the analysis that CFRA does, I like their reports. They do a good job. I may not always agree with their conclusions, but I like their analysis. They provide good detail. Okay. Schlumberger, this is one that I was recently called out of. And then I was able to place a new trade at the beginning of August, bringing in not quite 2%. So this one is on deck to expire not next week, but the week after that. So 2 weeks on this one. Barry's brought in $5 in premiums on 5 calls for MGA, which means Barry is looking for one of these. I'm just going to go ahead and give you 5 of them. There you go. Because that means your net cost basis on MGA is $37.50, which is really nice. That makes it. This is another reason why income generation, put sales, buying a stock, selling covered calls. This is one of the reasons I like it so much, is it makes it doesn't just provide that income source that is so useful, but it also makes it in not every case, but in a lot of cases, and Barry's example with MGA here is a really good example, makes it really easy to start thinking more objectively about what's happening in the stock around his original purchase price, because he's already $5 to the good. It increases objectivity. It doesn't decrease it. Yeah, plus $145 in dividends. Absolutely. Completely agree with that. Okay, let's talk about Pfizer. This is the trade that is coming up next week. And so with it being a week in advance, this is a good opportunity to kind of be a little bit more in the moment. I could get out right now and still be sitting. Yeah, absolutely you could. That is 100% true. But in the meantime, you've also got a nice little upward trend working for you. And why not try to take advantage of that? So, okay. With a week to expiration on the trade for Pfizer, this is a good opportunity to um, kind of be in the moment and try to actually think about, is there an adjustment that should be made, that I want to make, that I could make, that might give me a way to A, protect downside, B, increase compounding, or C, just maybe I need to stay the course. So with Pfizer on this one, I sold the $25 strike price, brought in 2.4% for a 3-week trade. This is a very nice trade. I only sold one contract on this. For full transparency, I'm holding shares at a much higher price. So for me, this was a trade that was as much about not only the income that I generated with the put sale, but also setting up an opportunity if the stock finishes below 25 to average my cost basis lower. So again, we're a week from expiration on this. The stock is following, it's really just tracing a lot right along its 20-day moving average. Even though right now it's a little bit below, you can still see that it's been stabilizing the last few sessions right around that 20-day moving average. Got pretty solid support right here. It's not a guarantee that it's going to rally back in the next week. It does have dividends coming up on the 25th. I fully expect to qualify for those. And possibly if it's below 25, I may qualify for a little bit more in dividends there. But this is one that does look like I could take an assignment on, and I'm okay. That's all right. That's not a bad result for me. I don't mind that. This will give me an opportunity to average from about 55 down into the low 40s, which will make the position a little bit easier to manage. And that's one of the other things to think about when you're talking about stocks in extended downward trends. There are questions about how long you let that trend ride, and for me, the answer is subjective, not objective, which is interesting. The reason I say it's subjective is because everybody's going to interpret data differently. The first answer, and this is more objective, is coming back to the company's core strengths. Are they still holding? Is the overall value proposition still in place? If the general answer is still yes, and that doesn't mean that the company may not have some things that they have to work through. But if I believe that the core strengths that have been driven their business all along are still in place, then I have a stronger reason to hold on to the stock. I look at these trades. When I take an assignment, these are stocks I want to own anyway. For lack of a better term, I think of these as legacy stocks. I'm trying to build a portfolio here, not only generate income. And so sometimes I take these assignments because these are exactly, I'm willing to go ahead and possibly, even if the stock continues to drop lower, I'm going to go ahead and I'm going to ride that. And that's what I've been doing in Pfizer. I've been riding it all the way from the high 50s down into, these low $20 range. And that's not been easy. I'm going to be honest. That's not fun. But I still believe in the overall business. And not everybody is going to agree with me on that. That's fine. The only time I will usually cut bait and move on is if I see a material deterioration in the overall business. And I just believe the better thing is, in that case, just to go ahead and let it go. That's only happened a couple of times, and to be honest, some of those kind of hurt. But for now, Pfizer's overall fundamental strengths are still in place. The value proposition here is very, very nice at the stock's current price. And if I am assigned that, for me, that's going to help me assign my cost basis a little bit lower. And the stock does have this nice little upward trend that it's building. This is starting to move from a short-term trend to an intermediate period of time, which is pretty nice. All right, that's Pfizer. Barry, I'm going to go back to Polaris. That was the other one you mentioned that we didn't address. So he, again, owns the stock, sold a $45 call on this one. So it looks like you're going to get called out here. Yeah, it's taken off on you, but that's okay. Gib, yes. I said there are some, these downward trends. Polaris, look at this. This is a downward trend that goes all the way back to 2023. So it's easy to talk about it, if you're in at 30 or something like that. But, what about all the way up here? What about when you're in at 140? That's painful. These downward trends can hurt. Walgreens Boots Alliance is one of those. Wow, just kind of flatlining lately. Nothing really going on. It's just kind of sitting there. In the meantime, here's CVS. So sometimes they do hurt. And this is where, something like a WBA, you have to decide, are you going to ride through this or not? Or are you going to cut bait? The picture is not necessarily getting better for WBA. Stopped paying a dividend last year. So all right. Barry, back in August, you're writing puts for 75, and now it's where it is. Yeah, that's exactly right. So these downward trends happen. Every stock is going to experience ebbs and flows. The ebbs are what brings the stocks down into valuation levels that we start to work with. And so this is one of the things that you have to understand when you are a contrarian. And Rebel Income, since one of the things that I'm looking for actively are stocks in downward trends, this is a contrarian method. I am looking for stocks that I believe may be at the bottom of their downward trends. But I'm also going in understanding that sometimes that means they're going to extend those downward trends, rather than reverse them. That's why I have to lean so hard on that fundamental strength. So Barry, for 4 puts and calls on Polaris, he's brought in 678 in premium. Nice. What is your purchase price on Polaris, Barry? $45. Okay. That's very good. $45, and technically you're getting, let me just double check my numbers here on Polaris. Yeah, no capital gain. That's what I thought. Your call was at 45. So you're not getting any capital gain, but with the income you brought in, you made $5. So you're more than 10% to the good, right? Makes that a lot easier. Now your capital is freed up, and then you could decide what you want to do next. I looked at Polaris earlier this year. I don't remember if it was after the last earnings report, though. Might be an interesting time to think about it. And a dividend for $67. Yeah. There you go. .66% on the dividend. Very much above average. I would want to look at the payout ratio, see what that looks like. I can't speak to what the overall strength or value proposition I think Polaris is, but it's obviously worked out well for you, Barry. You like Polaris and the company, then I've got no criticisms. So, all right. Now, in the weeks ahead, on the 1st, there's a couple of trades coming up here. I mentioned SLB. This is a new put sale at 35. Let's go ahead and check in on that one really quickly. And by the way, none of these are recommendations to buy or sell if you're not already in these trades. I'm just showing you the trades that I have been placing, and then trying to show you exactly how I'm evaluating them as the market is moving, and how those may or may not change my opinion, and some of the things that we can do to try to manage the trade and keep the income rolling, whether that means trying to limit downside, whether that means trying to move on, whether there's an opportunity to leverage compounding, whatever the case may be. So the stock is dropping back. We are seeing it start to pick up bearish momentum over the last week. And it has dropped below where I would have expected support at the 20-day moving average, and is approaching what I would expect to be new support. What is this? Probably around 33. Yeah, at about 33. So we're seeing an increase in bearish momentum here. And I sold the $35 strike price. So we're a couple of weeks to expiration on this. So that doesn't scare me necessarily. And the stock dropping down to 33 where I sold 35. Not such a big difference that I'm too worried about that. But again, this does beg the opportunity to evaluate different possibilities. So my method is really simple. I'm going to hold it through expiration. For me, the result is the result. I've said that before. But if you're looking at this chart, you're saying, okay, I placed this trade at 35. Here's the strike price that I sold, and we're seeing a very clear increase in bearish momentum. This is where some of the rollers in the Rebel Income community really emphasize loss minimization and mitigation. Okay, and actually, I'm in agreement with that. If you favor taking a more active approach in managing your trades, and you see this kind of increase in bearish activity, this may be a reason to close the trade out early and to move on. So for perspective, again, I brought in 65 cents on this put sale on the 1st of August. Excuse me. For expiration on the 1st of August, I sold this 9 days ago. So I've been in this for a week and a half. And it's now already $1 below the strike price that I sold. So let's go to August, week 1. And here is my $35 strike. I still don't know how that became a... Here's my $35 strike. Oops, $34.50. Sorry. Here's my $35 strike. And my asking price is $1.38. So if the point here is if I wanted to try to avoid any potential extra downside, I expect the stock to find support around 33. It's certainly not a given. It could go lower. That is a reality that I have to think about, especially with the stock still 2 weeks from expiration on my put selling trade. It's $1 below that right now. So technically, I could be assigned today. I could be assigned right now. I haven't been, but I could be. If you don't want to take an assignment, and a lot of the people that I work with and that I know that who use put selling prefer not to take assignments. This is more of a timing strategy for them, and that's fine. This would mean that it's time to buy the option back. Doing that means absorbing a loss of a little over twice the twice the amount that you brought in. So what is it? 60 cents from $1.38. It's $1.78, or excuse me, 78 cents. I apologize. You have to absorb a $78 loss if you sold one contract, which is what I did. You just make sure of my numbers here. Yeah, I sold one contract. 65 cents is what I brought in. So I'd lose 73 cents if I bought this back. But that $73 loss would be the end of it. That would eliminate the obligation. I wouldn't have to worry about whether or not it dropped further. By saying I'm going to let this extend for the next 2 weeks, I am opening up the possibility, even though I don't expect it, that the stock could drop below this support. And if it does, it could continue to drop much, much lower. If we go back, we can see if it does drop below this level, then next support drops below, yeah, I need to select my drawing tool again. There we go. If it drops below this 33, next support was going to be around here, which is at around 30. Apologize for my ugly lines. And then it's got additional tertiary support 2750, 25. So, this may not be done dropping. It is in a clear downward trend since 2023 that has seen it drop off of $60. That's part of the reason that it's a good value right now. There's a good bargain there. That's, the contrarian setup. And this consolidation range is something that I like, but that is a possibility. So that is one of the reasons that the more active rollers that I've worked with will go ahead and buy that back. They're going to minimize that risk, and they're going to move on, and that's okay. There's nothing wrong with that. If your approach is to be a more active roller, then actually that should be your method. You will incur more losing trades that way, but you will also increase your compounding effect. Okay. The other one that I have, the other put sale is on CVS. I sold the $62 strike on this one, brought in $1.90. That was this week's trade. So let's go ahead and check in and see how that one's doing. Just like with SLB, it's been dropping back for the past couple of weeks. It's part of what set up the opportunity for this trade. I expect it should find support right here around the 200-day moving average, if it continues to drop. That's around 61. So that's only $1 away from the $62 strike price I sold. For now, it's above it. Is it going to stay above it, below it? I don't know. We'll just have to wait and see. This is going ex-dividend on the 22nd, which means by selling the put option rather than buying the stock outright, I've passed up the opportunity to claim that dividend. Sometimes I will highlight a stock like this ahead of an ex-dividend date. And if you're paying attention, you're quick on the draw, you may decide to buy the stock instead, so you can pick up the dividend as well as have an opportunity to sell a covered call. Kind of do a little bit of double dipping to increase the income aspect. That's also kind of nice. In any event, all of these are still about 2 weeks from expiration. So we'll see how they play out and how they work out. The only other trade is another covered call that I was able to place on Barrick Mining. And I'm in on this one at 2050. I've been holding the stock for a little while. My last covered call expired, was at 2050, kind of like taking a page from Barry's book on Polaris, selling the same strike price that I bought the stock at. And it expired just a little bit below 2050 on the 27th of June. But I had an opportunity this week to sell another covered call that expires on the 1st at 2150. So I'm possibly baking in a little bit of extra capital gain if I do get called out on this one, as well as the income that I was able to generate, which was almost 3% on this one. So that was pretty nice. Let's see where Barrick is. It's a little below 21 now. It's getting a lot of consolidation, just a lot of chop here between about 2050 and 2150. So I think there's a fair chance that I don't get called out on this one. So it would have to break above that and stay above 2150. And so far it hasn't. So whether or not it is able to is an open question. So we'll see. We'll see where that goes. All right. Well, we've got a few minutes left and pretty much covered all of the open trades that I have. Barry shared a few of his. If any of the rest of you have some other trades you'd like to share, Barry, if there's any others that you've been able to put in place as well that you're willing to share, this would be a good time in the last few minutes of the live stream today to go ahead and share those. All right, no problem. Appreciate everybody's time and your participation as always. Please go ahead and make sure that you're sharing the link to this live stream with others. I'm trying to expand the audience. The Rebel Income is reaching, and I would appreciate anything that you can do to help me with that. Tell your friends about it. Send the link and tell them it's worth their time to if they're interested in trying to figure out some other ways to use the market to their advantage. In any event, I hope you have a wonderful weekend. Enjoy some time with your loved ones. Stay safe. We will talk again next time. If you have any questions, don't hesitate to let me know. rebelincomesystem@gmail.com is my email address. You can also reach out to me directly on Substack. Thanks, everybody.